Not all investments are the same. As a super fund member, you'll most likely get the option to choose how the money in your super is invested. It's an important decision and one that can have a big impact on how your retirement savings grow. One thing to consider when choosing an investment option is the level of risk you may be taking on, which is mostly determined by the type of assets your super money is invested in. Assets typically fall into two broad categories: defensive and growth. Defensive assets generally have a lower degree of volatility over the short term, but possibly lower returns over the long term. In comparison, growth assets generally have a higher degree of volatility over the short term, but potentially higher returns over the long term. Assets with similar behaviours and characteristics are grouped together into asset classes. There are four main asset classes: cash, fixed interest, property, and shares. Cash and fixed interest are defensive asset classes. Property and shares are growth asset classes. Investments in cash often bring a very low level of risk, but they also tend to provide the lowest expected long-term return of all the asset classes. Fixed interest includes term deposits, government bonds, corporate bonds, and debentures. These assets bring typically low to moderate risk. They generally provide better returns than cash over the long term, but lower returns than growth assets such as property and shares. Property includes things like residential, commercial, and also infrastructure properties such as airports. These assets often bring a moderate to high level of risk and returns. Property values can fluctuate more than fixed interest and cash, but generally less than shares. And shares. While shares typically offer the potential for higher returns, they can be extremely volatile, and price fluctuations can happen every day. It's important to note that some assets can have both defensive and growth characteristics. By including these assets in your portfolio, a further level of diversification may be achieved. An example is unlisted assets, which is any type of investment that's not listed on a public exchange, like the Australian Stock Exchange. This includes unlisted property, unlisted infrastructure, and private equity. Unlisted assets typically bring a moderate to high level of risk and provide relatively stable returns. However, they are also considered to be quite illiquid. When it comes to investing, often there is a trade-off between risk and reward. Generally, the more risk you take on, the higher the expected potential return. And the less risk you take on, the lower the expected potential return. Finding a balance that's appropriate for your personal circumstances and goals is an important part of making a good investment choice and helping you sleep easy at night. Before you make any decisions about your super, consider seeking qualified and professional financial advice.